Hey everyone, welcome back to Corporate Decoder. Ever wonder what happens when a company is so new, it's basically still in its packaging? Today we are diving into the very first annual report of Cantor Equity Partners, a blank check company that just had its initial offering last year. It's basically a financial fetus report, so let's see if this egg hatches. So Cantor Equity Partners is what they call a special purpose acquisition company, or SPAC. Think of it as a financial scavenger hunt. They raised money with the promise of finding a private company to merge with, which would then become publicly traded, kind of like corporate matchmaking. They're not picky. They're looking at companies in financial services, healthcare, real estate, tech, and software. They want a target with long-term growth, a competitive edge, and chances to improve how it's run. Ambitious. They launched their initial public offering in August of last year, selling shares for $10 each and raising $100 million, plus they sold some shares privately to their sponsor for another $3 million. All that cash went into a trust account, like a piggy bank waiting for the right deal. They have until August 2026 to find a company to merge with. If they strike out, the money goes back to the investors. No pressure. Of course, there are risks. They might not find a suitable target, or they might have trouble getting additional funding. Their officers might have conflicts of interest because they work for other companies too. It's a juggling act. And they have this deal with Cantor Fitzgerald & Co., an affiliate, to help market their business combination. This could get complicated, potentially creating conflicts of interest. To make sure everything is fair, the people in charge will decide if a deal is good value. If they can't decide, they'll get an expert opinion. Everything must be fair from a money point of view. They might need more money, which could dilute the existing shares. They're also aiming for targets that are bigger than what they can currently afford. So expect more fundraising. The business combination process is very competitive. Because there are so many SPACs chasing after so few companies, the prices will be higher and they are more likely to lose. Their team has experience in deals, operations, and capital markets. But they aren't working just for the company, they devote as much of their time as they deem necessary. And of course there are benefits to being a public company, but because they are new, they do not have experience yet. These guys also plan on bringing their experience to the target and make sure it's all rainbows and sunshines. Let's look at who owns what. There are two types of shares, the Class A and Class B ordinary shares. Those shares dictate voting rights in theory. The last day of the period, there was no market value for the ordinary shares at the time of this statement. However, it is 139 million. It's good to see that there's investor confidence. All right, now let's dive into the financials. Fasten your seatbelts. All right, here are some very early numbers. They ended with 25K in cash and 102 million in debt securities. 1033 million Class A ordinary shares, 443,000 in liabilities, and a poor shareholders deficit. They had a good year with some profit, $1.5 million, which is rare for SPACs that are searching. It could have to do with the time period where it was earning more interest because rates were high. The prior year they had a 252K loss. They also don't have much equity because they just launched and are only worth 300,000. They had a poor accumulated deficit because all it was doing was losing money. Their investing activities showed that almost all of the cash that they received was used for the purpose of this. So in truth, their balance is quite tight. No changes to their financial reporting. At said, with a new business, internal controls can be a risk. This might need fixing, but it will cost money. Interesting factoid that is required to be said, but is good nonetheless. It means that the insiders have not been secretly trading. The audit committee has some experience in the space. They adopted a code of ethics, good to make sure things are ethical at least. They have no real executive compensation except reimbursement for some activities. The auditors are also independent, so all good practices. Okay, let's dive into who really calls the shots. The sponsor, Cantor EP Holdings, owns most of the shares. A few others have sizable chunks too, like MNCap International and Aristea Capital, so it's not just a few people making decisions here. Several firms are vested in its success. There's a web of connections with Cantor and related parties. They're paying for office space, and Cantor is advising them on the business combination. Conflicts of interest are all over this deal, but they are addressing this fact by getting some expert help and third opinions. The audit fees were roughly 88,000, which included some filings. The year before was just 28,000. Overall, what's my take? This is a young, hungry SPAC looking for a deal. The financials show a company just getting off the ground, trying to not bleed money. The team has experience, but there are some conflicts of interest that they will need to manage, and they need to find the right target in a limited amount of time, or else the whole thing falls apart. In short, this is a high-risk, high-reward game. The potential for big gains is there, but there are plenty of hurdles to clear first. You should definitely subscribe for more in-depth looks into other companies and be sure to click like.